The sell-off in equity markets continues to happen, with the S&P 500 falling 4.37%, making it a week loss of 15%. From the peak, the S&P 500 has now lost 32%. Today was a pretty turbulent day in trading, as earlier in the day, the S&P 500 was actually up about a percent, but continued to fall throughout the day. In terms of sector, the loser for the day is the utilities, falling about 6.5%. Second loss was the consumer staples, falling 5.6%. Surprisingly, though, the winner was energy, which was actually up 1.3%. The Dow fared even worse, falling 4.61%, making it a week loss of over 17%. In total, from the peak, the Dow has fallen 35%. The Nasdaq fell 3.8% on the day, making a week loss of 12.6%. From the peak, the Nasdaq has fallen 30%. In Canadian markets, the S&P/TSX Composite fell 2.62% on the day. Unfortunately, though, it was actually trading pretty well earlier in the day and was actually up 3.5%. But over the day, with more things closing down and bad news, it reverted to a loss. Over the week, it's fallen 13.6%, and from its peak, it's fallen a total of 34%. In Europe, the FTSE was up 0.76% on the day, and in Asia, the Nikkei was down 1.04%. Oil had a really rough day again, with WTI falling over 21% and is now below that $20 mark. Surprisingly, though, Brent crude oil didn't fall that much and only fell 2.95%. Looking at that differential, it's closer to that $8 mark, which is closer to what it usually is from previous times. Gold was up 0.62% on the day, but just looking at that price, it's at that 1488 mark, hasn't been performing very well. Looking at yields, the Canada and US Treasury yields, not too much going on. Canada is relatively the same. The US, though, yields have been falling, but that is understandable considering the increased in quantitative easing that the government is doing. Overall, it's hard to tell exactly what the market is doing in this terms when you have many governments increasing their quantitative easing programs and buying back billions of dollars worth of bonds. In the currency markets, the loser for the day is the Japanese yen. While it was performing quite well previously, it has been taking a turn for the worse. The euro also had a rough day as well as the US dollar. On the upside, the Canadian dollar actually had a decent day, is slightly up, especially versus the US dollar, getting close to that 70-cent mark again. The British pound is also up, as well as the Australian dollar. The Federal Reserve continues to take action as now they're expanding their emergency program to try and include municipal and state treasury bonds, as those securities are having issues of liquidity as their rates continue to increase higher and higher. So municipal bonds are actually headed for their worst drop since 1981, as they're headed for an 8% drop. Overall, it's not a good look going forward. And I'd have to say, this just adds to another thing the Fed has to do. But it's hard to say how much impact it's going to have overall. There's at least some good news coming out of the United States as their home sale numbers for February came out, which was a 13-year high. Home sales jumped 6.5% in February, which is pretty good jump. But on the downside, that is February and won't have the impact of the slowing market, as it's expected that it could drop 30% over the coming months. So some good news, but overall, you gotta take it with a grain of salt. The good news in the United States doesn't last long, as their jobless claims rose 70,000 yesterday to 281,000 for the week. This isn't very good news and is expected to get worse. As this article shows, Goldman Sachs is expected that 2.25 million jobless claims will happen this coming week. Bank of America also expects that in total it will be 3 million jobless claims, and also expect that GDP could potentially plummet 12% in Q2. It is expected that these jobs will be lost as many people are being laid off because they can't go to work because places like California and New York are pretty much locked down now as the virus continues to fluctuate through those areas. Overall, it's hard to say how many people are going to be on unemployment, but it's going to continue to not only increase the money the government has to spend on unemployment, but it's going to decrease the revenue they take in, and it could potentially increase that budget deficit even further, even with all this stimulus going in. Also, Philly Fed's manufacturing activity index fell a staggering amount, is now at negative 12.7, which is an 8-year low from the 3-year high of 36.7. Not a good look overall. With a lot of news going on about stimulus packages and the benefits of them, I thought this article was an interesting look on how it's going to affect the budget, as they expect that Canada's budget deficit will pass 100 billion Canadian dollars this year, which is a pretty staggering number. As 27 billion dollars of stimulus was announced on Wednesday, the Bank of Nova Scotia actually expects that that will be doubled. This is a significant increase from the proposed $28 billion deficit that was previously expected. The reason for this isn't just the stimulus, it's also the lower tax revenue that they get, as well as increase in unemployment payments that aren't necessarily going to have anything to do with the increased stimulus packages. It's more just a general thing, and it will continue to increase. That's a total of 5% of the Canadian economy. In 2019, there's a budget deficit of 27 billion, the size of 1.2% of the economy. And this is the largest amount increase since 1982. I mean, some of it is expected, but I think this really shows is the issue with governments continuing to take debts on. Well, you might say, oh, it won't be an issue. They'll be able to pay off that 100 billion. They will be able to. But when you keep having years and years of deficits, like 2019, you had a $27 billion deficit. Why are you taking that deficit near the end of a growth period? As many people have expected, we were in a long bull market that we aren't anymore. And when you keep taking debt on the government in the bull market, when are you going to pay that off? It seems like it's standard now to continue to take on debt, and it really doesn't leave you as much room as you might want or could possibly have in a situation like this. Because say the past few years they even paid off some of the debt, there would be less concern about increasing debt. They'd have so much more room. And overall, just something they wish they did, but doesn't seem likely to happen in the future. The Canadian government has also announced that they will be expanding their mortgage guarantee by acquiring a total of 50 billion Canadian dollars in a state purchase program. So they're planning on pretty much guaranteeing mortgages that are uninsured ready to try and help certain institutions with their liquidity issues. As there's been decent amount of liquidity issues in many areas, as banks and institutions aren't getting in the cash that they normally expect. While it shouldn't be a problem, especially with the OSFI capital ratio guidelines, it could it still has an impact on how much money that comes in, as it affects how much money that they can send out, as most banks' business is basically offsetting their loans. Canada has kind of followed the US lead as they announce potentially making manufacturers help produce medical supplies and equipment as there are shortages going on. Brunt of this issue, especially in the US, is they're having issues trying to get these supplies as most of them are made in China, and China is holding them because they want them pretty much. Just, um, kind of understandable considering it's China. But their plan is to get about, they got like 15 companies that they're hoping will uh, join in this effort. It's kind of like a war thing, as most of the bills kind of have that in the name, as they expect to make places that don't necessarily used to making it. For example, here they got automotive companies. Canada Goose, surprisingly, even plans to help use their production infrastructure to help produce these much needed supplies for the virus. Continuing the talk on supply chains, I thought this article was pretty interesting, bringing the point that supply chains around the globe are having issues as many things are getting shut down. Like as it says here, Apple is confronting the impact of component market makers in Italy, Germany, Malaysia, and South Korea after having weathered the February slowdown in Chinese factories that do the final assembly of products like iPhones and AirPods. You can also see it with Canada planning on making supplies in medical supplies in Canada, the US doing the same. And it's really interesting to see what will happen after everything cools down because globalization has been on the rise, but it has been talked about a lot lately about is it good or is it not? Especially if you look at Trump's rhetoric, how he criticizes globalization and moving manufacturing jobs away. I imagine a lot of stuff like that will continue to prop up as things like this can continue to happen, especially when you have medical supplies that you really need. It could change the way economies look at globalization, maybe making more of their stuff in their own place. At the same time, it needs to be said that this will increase issues of efficiency in the markets and will have a detrimental effect in that place. But if you continue to see issues like COVID-19 or potentially other things going into the future with increased globalization, then the benefits might not outweigh the costs. Now, this jobless claims really shows you how bad things are getting and will potentially get even worse over the coming month. As in Canada, Prime Minister Justin Trudeau has announced that 500,000 Canadians have applied for jobless claims this week, which is 2.5% of the labor force, which is insane. For example, that's 20 times the number recorded a year ago for the same week. This is not a good look going forward for Canada. Now, as I was saying before, this is really going to increase those unemployment costs for the government, as well as decrease the revenue that they're going to get from income taxes. Hopefully, things turn around quickly and don't continue to be this dramatically bad. Let's move on and talk about another big thing going on in the world, and that is the oil price war between Russia and Saudi Arabia. What I have to say about it is it's really not a good time. I'm not sure why Russia and Saudi Arabia are at heads right now. It doesn't make sense. I guess they might not expect the virus to hit them very hard. I don't really know exactly what's going on in terms of the virus affecting them, but it's going to affect them, especially it's already affected the oil prices before this was going on. And you have the increased aspect of the price war, it really doesn't make sense to me and just seems kind of stupid of these countries to do this right now. I get having a price war maybe 5 months from now, 6 months from now. Just don't take it out now. Feels like it's going to hurt you more than it's going to help you overall. But out in Texas, they're having a lot of issues because, I mean, with low oil prices, they're not really making money, especially with the cost of producing that, maybe higher than it is to actually sell it. But right now, Texas is potentially looking at a 10% production cut as they want to potentially have a meeting with Russia and Saudi Arabia into having them all, I guess, cut production by 10%. They actually announced that they have been invited to the next OPEC meeting, so hopefully something ends up coming out of that. But what is kind of interesting is that MUFG has actually suggested that this poses a problem for Saudi Arabia and Russia going forward with the price this low, as they suggest they'll have challenging fiscal outlook for both of those countries if the price stays below $40 per barrel. This article really shows you the impact that this oil price war is having on the oil industry in connection with the virus. It says tens of thousands are getting laid off in US shale patch. This is kind of expected with the coronavirus going on this summer. the oil price war isn't helping at all. For example, in terms of capital spending by oil companies, U.S. has decreased it by $12.6 billion for the year and could see that dropping even further. Citibank even expects that there'll be a 40% contraction in U.S. oil service markets. Some expect a 40% drop in earnings. There's actually a company here, Halliburton, expects that the earnings will fall 40% this year, and then the year after by 30%. So overall, not a good look for the industry going forward, unless maybe something happens with the price war.